Welcome to the deep dive. Today, we're taking a closer look at life insurance policies. We're going to break down the common provisions, the different options, and, those riders you can add.
It's a topic that, yeah, it can feel a bit complicated, but underneath it all, there's actually quite a bit of consistency. Life insurance policies aren't exactly standardized, but state rules and NAIC guidelines mean they share a lot of common ground.
Exactly. So think of this as like a shortcut to understanding it all. We've gone through a chapter covering these provisions, options, and riders, and our aim today, pull out the really key stuff.
Right. We want to highlight what's similar, point out the variations you might encounter, and just give you a clearer picture of how these contracts work without, drowning you in jargon.
Our mission is clarity, maybe revealing a few surprising details and giving you the knowledge to feel more confident about this.
Let's get into it.
Okay, let's dive in. Starting with the general provisions, our sources say these are pretty much standard across the board, right?
Mm,
Very similar between insurers.
that's right. These are kind of the foundational rules. They protect your rights as the policy owner and spell out the duties for both you and the insurance company. Sets the stage, basically.
First up is the entire contract provision. What's the main point here?
Okay, so this one's important. It basically says the policy itself, your original application, and any riders or endorsements you added, that's the whole agreement, period.
Meaning they can't just refer to some other document later to deny a claim.
Exactly. Nothing can be incorporated by reference. It stops the insurer from pulling out some internal memo you've never seen. And it also means they or their agents can't just change the policy terms after it's issued.
Right, right. That makes sense. But what if we both agree to a change, like later on?
Ah, good question. That's allowed. Mutually agreed changes, endorsements, riders, amendments are fine, but they have to be in writing, attached to the policy, and signed off by an authorized officer at the company and agreed to by you.
Okay. Next, the execution clause. Sounds simple. When does the policy actually kick in?
It is pretty straightforward. It just clarifies the contract is live once both sides have met their initial conditions. You've paid the first premium, they've issued the policy.
Got it. Then the modification provision. Seems like it reinforces that entire contract idea.
It does, yeah. It hammers home that any changes have to be written, formally added, and authorized by someone high up at the insurer's home office. Your agent can't just say, oh yeah, we'll change that for you. Needs to be official.
Understood. Now, the privilege of change clause, or policy change provision, sounds like I get some flexibility.
You do. It outlines how you can request coverage changes. And here's an interesting bit. If you want to, say, change to a policy type that has higher premiums but the same death benefit, you generally don't need to prove you're still healthy.
Okay, because the insurer isn't taking on more death benefit risk. But what if I want to lower my premiums or increase the face amount?
Ah, that's different. Then you likely will need to provide proof of insurability. The insurer needs to protect against adverse selection. Someone finding out they're ill and then trying to switch to cheaper term insurance or bump up their coverage. It wouldn't be fair to other policyholders.
That makes perfect sense. Okay, moving on. Insuring clause provision. This sounds like the absolute core promise.
You nailed it. This is the fundamental pledge from the insurer. We promise to pay the death benefit when the insured person dies. It's usually right there on the policy's face page.
And what specific info is usually in that clause?
It'll state the death benefit, the face amount, your annual premium, how often you pay it, and who the beneficiary is. But it's important to remember that promise is still subject to all the other policy provisions, exclusions, and conditions.
Right, the details matter. Then there's the consideration clause. What's the consideration here? What's being exchanged?
Okay, so for any contract to be legal, both sides have to give something of value. That's consideration. Your consideration, as the policy owner, is primarily two things: filling out the application truthfully, especially about your health, and paying that first premium.
And the insurer's consideration.
Their consideration is their promise to pay that death benefit if the claim is legitimate, once they get proof of death, like a death certificate.
What if the consideration isn't, well, complete? Like, my first check bounces.
If that first premium payment fails, say the check bounces, then legally speaking, the contract never really started, no coverage. Or if you significantly misrepresented your health on the application, that's also a failure of consideration. They might void the policy later, though they'd usually have to return the premiums you paid in that case.
Okay, that seems fair. Now, the incontestable clause. This sounds like a pretty big protection for me as the policyholder.
It really is. It's a major safeguard. After a set period, usually 2 years from when the policy starts, the insurance company cannot contest the policy's validity. Even if they later find a misstatement or concealment on your original application, even fraud, they generally can't use it to deny the claim as long as you've kept paying premiums.
Wow, so after 2 years, they can't just find some small error on my application and cancel.
Generally, for the main death benefit and any death benefit riders, yes, it provides certainty. But there are a couple of caveats. It usually doesn't apply to things like accidental death or disability riders within the policy. And there are some very specific exceptions.
All kind of exceptions.
Well, the big ones are things like outright impersonation, someone pretending to be you, or if there was absolutely no insurable interest when the policy started, or, in truly rare cases, if it's proven the policy was taken out with the intent to murder the insured. In those extreme situations, the insurer might be able to contest it any time. And of course, not paying premiums can always void the policy. And misstating your age or sex, that's handled differently.
Right. Which brings us to the misstatement of age or sex provision. So if I get my age wrong, accidentally, or maybe not so accidentally.
They don't void the policy. Instead, they adjust the death benefit. It gets adjusted to whatever amount the premium you did pay would have bought at your correct age or sex. The benefit might go up or down, depending on the mistake.
So even if someone intentionally lied about their age to get a lower premium, the policy isn't canceled, just the payout is adjusted.
That's typically how it works, yes. They recalculate based on the truth. For instance, say someone said they were 35, bought a $100 K policy for $100 a month. Turns out they were actually 40, and the premium should have been $125 a month. The death benefit will be adjusted down to $80,000, which is what a 100-month would have bought for a 40-year-old, $125,000.
Okay, that's clear. Now, the suicide clause, a sensitive topic, but important.
Very. Most policies have this. It states that if the insured commits suicide within a specific time frame, usually the first 2 years the policy is in force, the insurer won't pay the death benefit.
What happens instead?
They'll just refund the premiums that were paid up to that point to the beneficiary. The idea is to prevent someone buying a policy with the immediate intention of suicide.
And after that initial 2-year period?
After the 2 years, suicide is generally covered like any other cause of death, and the full death benefit is paid. So, timing is key here. Suicide after 6 months, premium refund only. Suicide after 3 years, full death benefit.
Got it. Let's shift to the owner's provision, the rights of ownership. Who holds the reins here?
The policy owner holds all the rights. They're in the driver's seat.
And what kind of rights are we talking about? What can the owner actually do?
A lot, actually. They can change the beneficiary, assuming it's revocable. They can borrow against the cash value if it's a whole life policy, choose how often to pay premiums. They can even transfer ownership to someone else. It's called assignment. And if it's a participating policy from a mutual company, they get dividends, maybe even vote in company elections. They can convert or renew term policies if applicable, exercise options like guaranteed insurability. Yeah, lots of control.
Is the owner always the same person as the insured?
Often, yes, but definitely not always. Think about a policy on a child. The parent is usually the applicant, owner, and payer, but the child is the insured. Or maybe in a divorce settlement, one ex-spouse might own a policy on the other's life.
That makes sense. Which connects to this applicant control or ownership clause. That's specifically for minors.
Exactly. When a policy is issued on a minor, this clause typically states that the applying adult, the parent or guardian, retains full ownership and control until the child reaches a certain age, maybe 18 or 21.
Okay, and you mentioned transferring rights. Let's look at the assignment provision.
Right. This provision allows the policy owner, the assignor, to transfer some or all of their rights under the policy to another person or entity, the assignee.
Does the insurance company have to approve it?
Nope, their permission isn't needed. But you do have to notify the insurer in writing so they can record the assignment. Interestingly, the assignee doesn't need to have an insurable interest in the insured person's life.
And there are different types of assignment, absolute versus collateral.
Yes, an absolute assignment is like selling the policy a complete, usually permanent transfer of all rights. The new owner takes over completely. Collateral assignment is different. It's partial and temporary, often used to secure a loan.
How does that work?
You might pledge the policy's cash value to a bank as collateral for a loan. If you die before repaying, the bank, the assignee, gets paid back from the death benefit first, and your beneficiary gets whatever is left over. It's like putting a lien on the policy.
I see. How does assigning the policy affect the beneficiary?
It depends. If the beneficiary is revocable, meaning you can change them anytime the policy owner can assign the policy freely. The assignee might even be able to change the beneficiary later. But if the beneficiary is irrevocable, meaning you need their written consent to change them, then you also need their consent to assign the policy. And usually the assignee cannot change an irrevocable beneficiary. It protects their vested interest.
Okay, that distinction is important. Let's move to something helpful for new policy owners, the free look provision.
Ah, yes, the buyer's remorse clause, basically.
Yeah.
It gives the new policy owner a set period, usually 10 days. But state laws vary right after the policy is delivered to review it.
And if they don't like it.
They can return it for any reason or no reason at all and get a full refund of any premium paid, no questions asked. It's mandatory for most life policies, except maybe things like flight insurance bought at the airport. The clock starts ticking once the policy is delivered, usually confirmed by a signed receipt.
Good consumer protection. Now, paying the bills. The mode of premium provision.
This just outlines your choices for payment frequency. Annually, semi-annually, quarterly, or monthly.
Is one way typically cheaper?
Yes, paying annually is usually the least expensive option. Fewer transactions mean lower admin costs for the insurer, and they often pass that saving along. Monthly payments usually cost the most overall due to the higher processing frequency.
Makes sense. Now, what if I miss a payment? Life happens. That's the grace period provision, right?
Exactly. This is a safety net. It gives you a buffer period after the premium due date, typically 30 or 31 days, during which the policy stays in force even though you haven't paid. No penalty.
So coverage doesn't just stop immediately.
Correct. If the insured dies during the grace period before the missed premium is paid, the death benefit is still paid, but they'll subtract that overdue premium from the payout. It prevents unintentional lapses. It keeps the policy going without needing new health proof or facing higher rates due to age.
And if I miss the grace period too and the policy actually lapses, is there a way back? The reinstatement provision?
Yes, this provision offers a chance to reactive a lapsed policy, usually within 3 years of the lapse, sometimes longer.
What's required?
Generally, you need to provide proof of insurability. Again, show you're still in decent health. You also have to pay all the back premiums you missed, plus interest, and repay any outstanding policy loans, plus interest. There's often an automatic reinstatement feature, too. If the insurer doesn't formally reject your reinstatement application within about 45 days, it's considered automatically back in force.
What's the big advantage of reinstating versus just buying a new policy?
The main benefit is logging back in your original premium rate based on your age when you first bought the policy. That can be a huge saving compared to buying new at an older age. One thing, though, a new 2-year contestability period usually starts for the statements made on the reinstatement application, but there isn't a new suicide clause period. And if you fully surrender the policy for cash, you can't reinstate it.
Okay, that covers the general ground rules. Now let's get into provisions and options tied specifically to cash value. This is mainly for whole life policies, correct?
That's right. These deal with the equity buildup in permanent policies and how you can access or use it.
First is the excess interest provision. What's excess interest?
Okay, so whole life policies have a guaranteed minimum interest rate for cash value growth. But if the insurer's investments do better than that minimum, this provision allows them to potentially credit your policy with extra interest. Your cash value could grow faster than the guarantee. It might be linked to an index or the insurer's overall investment results. Potential bonus.
Sounds good. Now, non-forfeiture cash values. This sounds like a guarantee I won't lose my built-up value if I stop paying.
Exactly. It's a legal requirement now. Years ago, if you stopped paying, you could forfeit everything. Now, insurers must give you access to your accumulated cash value if you stop paying premiums after a certain period, usually after 3 years, but often sooner. You don't lose that equity. Just remember, any outstanding policy loans get deducted from the cash value before you choose one of these non-forfeiture options. There are 3 main choices.
Let's cover them. First, cash surrender option.
The simplest one. You tell the insurer you want to terminate the policy and take the cash value. Coverage ends. They send you a check for the net cash value. Legally, they can delay payment up to 6 months, though it's rare. Tax-wise, the cost recovery rule applies. You get back your total premiums paid tax-free. Anything over that amount is taxed as ordinary income. You can sometimes do partial surrenders too, but once you fully surrender, the policy's gone for good. Can't be reinstated.
Okay. Second option, reduced paid-up option.
Here, you use the net cash value as a one-time single premium to buy a new whole life policy. It's the same type of policy, but with a lower face amount. No more premiums are ever due on this new, smaller policy.
Hmm.
It still builds cash value, and if the original was participating, the new one likely is too. The amount of coverage is based on your current age, but no new health proof needed. Riders from the old policy usually drop off. This gives you permanent coverage for the longest time without paying more premiums.
And the third option, extended term option.
With this one, you use the net cash value to buy a term insurance policy. The coverage amount is usually the same as your original policy's face amount, minus any loan, but it only lasts for a specific period determined by how much cash value you had and your current age. Your policy will have a table showing how long the term coverage lasts. This is often the automatic default if a policy lapses and they can't reach you. If there was a loan, the loan amount reduces both the cash value used and the face amount of the term coverage. This option gives you the most insurance protection, highest face amount, but only for a limited time.
Those are really valuable options for someone who stops paying premiums. Now, what about accessing cash value while the policy is still active? The policy loan provision.
Right, this is a key benefit of owning whole life. It gives you the right to borrow against your accumulated cash value. It's really more like an advance of your own money rather than a traditional loan.
Why in advance?
Because the insurer can't demand repayment on a set schedule. You can repay it whenever you want, or not at all, though interest accrues. No credit checks needed. The cash value secures the loan, though if you have an irrevocable beneficiary, you might need their permission to borrow. The max loan is usually the cash value minus any interest they project will accrue in the next year.
What's the impact of having an outstanding loan?
Big impact. Any unpaid loan balance plus accrued interest directly reduces the death benefit paid to your beneficiary. It also lowers the cash surrender value if you decide to cash it in, and it affects the other non-forfeiture options. Less value means less paid-up insurance or a shorter extended term period.
And interest is charged, right?
Yes. The insurer charges interest because they lose the potential investment earnings on the money you've borrowed. Rates vary ahead. Some policies have fixed maximums. Others have variable rates tied to indexes. Interest is usually billed annually. If you don't pay it, it gets added to the loan balance. If the total loan ever exceeds the cash value, the policy could lapse. And remember, policy loan interest is generally not tax deductible.
Why do people typically use policy loans?
All sorts of reasons.
Yeah.
Personal needs like debt, emergencies, education. Businesses use them too, maybe on key person policies. The rules are the same, but you always have to weigh the benefit of the cash now against the reduction in the future death benefit.
Yeah, that's a critical trade-off. You mentioned earlier the insurer has a right to defer a loan.
Yes, most policies allow the insurer to delay paying out a loan or cash surrender value for up to 6 months. It's a safety valve to protect them against a run on the bank, essentially, if too many people demanded cash at once during a crisis. But this delay doesn't apply to paying death claims or to automatic premium loans. And they can't delay if you're borrowing specifically to pay the premium due.
Okay. That leads nicely to the automatic premium loan provision. Sounds like a useful feature to prevent accidental lapse.
It really can be. If you choose this option, and you usually have to elect it, it's not automatic, unless you ask that. The insurer will automatically borrow from your cash value to pay a premium if you miss it by the end of the grace period. As long as there's enough cash value, it keeps the policy from lapsing unintentionally.
So it's a backup payment system.
Pretty much.
Yeah.
You often add it at application, sometimes later as a rider. No extra cost to add it. Only works on cash value policies, obviously. The withdrawn amount becomes a policy loan. It keeps going premium after premium until the cash value runs out, unless you start paying again.
And these automatic loans are treated just like regular policy loans.
Exactly. Same rules on maximum amount, interest, impact on death benefit, and cash value. Insurers might limit how many consecutive premiums they'll pay this way, though.
All right, that covers cash value well. Let's switch to the payout side. Provisions and options related to policy proceeds. How the money gets to the beneficiary.
Absolutely crucial. This is, after all, the main reason for the policy. Thinking about the purpose and the beneficiary's needs is key when considering these options.
Makes sense. First, beneficiary designation provisions. Seems straightforward who gets the money.
It is fundamental. You, the owner, name the recipient. It's part of the contract. Beneficiaries usually don't sign anything or even need to know they're named unless they're irrevocable. And you can usually change revocable beneficiaries whenever you want.
Then settlement options provision. This is about how the money is paid out, not just who gets it.
Precisely. The default is usually a single lump sum payment, tax-free typically. But this provision outlines other ways. The beneficiary might choose, or you might dictate, installments instead. The insurer holds the proceeds and pays them out over time with interest. Important note, while the death benefit itself is usually tax-free, any interest the insurer pays on proceeds they hold for the beneficiary is taxable income to the beneficiary.
I see spendthrift clause mentioned here too. What does that do?
This is a protection you, the owner, can put in place, often by selecting a settlement option yourself. It helps shield the policy proceeds while held by the insurer under an installment option from the beneficiary's creditors. If you're worried about a beneficiary, maybe mismanaging a lump sum or having creditor issues, this can offer some control and protection.
Interesting. And the withdrawal provision.
This applies if proceeds are left with the insurer under a settlement option. It just details how and when the beneficiary can withdraw funds if allowed by the specific option chosen. Maybe they can take partial withdrawals, maybe only up to a certain amount per year.
Okay. Now, what about accessing benefits before death? The accelerated death benefits provision, often a rider.
Yes, this is a really significant feature. It allows the insured person, if diagnosed with a terminal illness, usually defined as having 24 months or less to live, confirmed by a doctor to receive a portion of their own death benefit while still living.
So tapping into it early for medical bills or other needs.
Exactly. You can typically access a percentage, maybe 50% or 75% up to a certain limit. The amount received is then subtracted from the final death benefit paid to the beneficiary. These accelerated payments are generally received income tax-free if you qualify as terminally ill.
How is the money paid? Lump sum.
It can often be paid as a lump sum or sometimes in monthly installments. There usually isn't an extra premium for this rider, but the insurer might effectively charge interest by reducing the amount paid out slightly to account for paying it early. Insurers have to provide clear disclosures about how this works, the triggers, the impact on the policy, and potential tax or government benefit consequences.
Are there variations besides just terminal illness?
Oh yes. You might see riders for catastrophic, chronic, or critical illness. Similar concept, but triggered by specific conditions like cancer, heart attack, stroke, or maybe the inability to perform a certain number of activities of daily living, ADLs, like bathing, dressing, eating. There's also a specific long-term care rider. This pays benefits if the insured needs long-term care, maybe in a nursing home, usually triggered by inability to perform 2 or more ADLs. These benefits are also typically tax-free. LCC riders can be integrated, meaning benefits paid reduce the death benefit, or independent, where they don't affect the death benefit as much or at all.
These accelerated benefits seem incredibly helpful in difficult circumstances. Okay, let's move on to options related to policy dividends. This is mainly for participating policies from mutual insurers, right?
That's right. Mutual companies are owned by policyholders, so if the company has a better-than-expected year financially, they might return part of the premiums to policyholders as dividends. Stock companies mostly issue non-participating policies, but sometimes offer participating ones too. Crucially, dividends are not guaranteed. Policies have to state this clearly. Agents can show past history but can't promise future payouts. They're generally considered a return of premium, so they aren't taxed as income.
Where does the money for dividends come from?
3 main sources: better than expected mortality, fewer death claims, higher than expected investment earnings, and lower than expected operating expenses. If there's surplus money after all that, they might distribute it as dividends.
When do policyholders usually get these?
Typically starts after the first or second policy year, paid on the anniversary date. The policy owner chooses one of several dividend options for how they want to receive them.
Let's use that acronym, CRAPO, to remember the options. First, C, cash.
Simple. They send you a check for the dividend amount, tax exempt.
R, reduced, reduction, or suspension of premiums.
The dividend is automatically applied to lower your next premium payment. If the dividend is large enough, it might even cover the whole premium for that period. Helps with cash flow.
Pay, accumulate at interest.
You leave the dividends with the insurer in an interest-bearing account. The dividends themselves aren't taxed, but the interest earned on them is taxable income in the year it's credited, even if you don't withdraw it. Over time, this can build up significantly and might even be enough to eventually pay up the policy early.
PEO, paid up permanent additions, PUA. Sounds like buying more insurance.
Exactly. The dividend is used as a single premium to buy small additional chunks of fully paid up whole life insurance. The amount depends on your current age and the dividend amount. No health questions asked. This increases both your total death benefit and your cash value over time. often considered the best way to maximize long-term value.
And, oh, 1-year term insurance.
Here, the dividend buys as much one-year term insurance as it can, often up to the policy's current cash value amount. This temporarily increases your death benefit.
Mm.
Any leftover dividend can be applied to another option, sometimes used to cover a policy loan balance. This usually requires a specific rider and maybe proof of insurability if you switch to it later.
Lots of flexibility with those dividends. Okay, final major section. Life insurance policy riders, the add-ons for customization.
Exactly. Riders add extra benefits or modify the policy. They usually cost extra premium, typically added at application, but sometimes later if the insurer allows. And importantly, if the main policy lapses, the riders lapse too.
Let's run through some common ones. Waiver of premium rider.
Very popular. If you become totally disabled, usually for 6 months straight, the insurer waives all future premiums for as long as you remain disabled. The policy continues as if you were paying cash, value grows, dividends are paid, loans are possible. The waived premiums aren't owed back, costs extra, but usually worth it. Typically ends at age 60 or 65, but if disability starts before then, the waiver continues. Definition of disability varies. Own occupation versus any occupation. Excludes war, self-inflicted injury, illegal acts.
How about the waiver of cost of insurance rider?
This is more common on universal life policies. It typically only waives the monthly cost of insurance charge, not necessarily the full premium you were paying to build cash value. So the policy stays in force, but cash value might not grow as fast.
Then the disability income benefit rider provides actual income.
Yes. If you become totally and permanently disabled, this pays a monthly income benefit, often a percentage of the face amount, like 1%, maybe capped. Usually starts after a waiting period, often includes waivers of premium too. The benefit amount depends on the policy face amount, unlike waiver of premium, which depends on the premium amount.
Okay. Accidental death benefit, ADB rider, or double indemnity.
Pays an additional death benefit if death results directly from an accident, often within 90 days.
Right.
Can double or triple the face amount. It's cheap extra coverage, but very specific. Excludes illness, suicide, war, risky activities, often private flying, usually has age limits, doesn't affect cash value, doesn't apply to PUAs.
And accidental death and dismemberment, AD&D.
Similar, but also pays a benefit, capital sum, usually half the death benefit or principal sum, for specific severe injuries, like losing a limb, sight, or hearing due to an accident, not for minor injuries.
Guaranteed insurability option, GIO or FIO. Sounds like a good one for younger people.
Definitely. Allows you to buy additional permanent insurance at specified future dates, for example, every 3 years, or life events, marriage, birth of child, without proving insurability. No medical exam needed then. You buy at your attained age rates. Great way to lock in future coverage eligibility.
Cost of living adjustment rider, COLA, for inflation.
Yep. Automatically increases the face amount periodically, usually tied to the Consumer Price Index, CPI, to help the death benefit keep its purchasing power. Premiums increase too for the added coverage. You can usually decline an increase.
Payer rider, for policies on kids.
Exactly. If the adult paying the premium on a child's policy dies or becomes disabled, this rider waives the premiums until the child reaches a certain age, like 21 or 25, and only covers the premium, no other benefits.
Exchange privilege rider, for businesses.
Mostly. Used on key employee policies. Allows the business owner to change the insured person if one key employee leaves and another is hired, without canceling the policy. Premiums adjust for the new insured.
And finally, term insurance riders, adding temporary coverage.
Right. An inexpensive way to add extra death benefit for a specific term, like 10 or 20 years, onto a permanent policy, cheaper than a separate policy. Examples include level term, fixed benefit, decreasing term, benefit drops, good for mortgages, increasing term, benefit grows, maybe to return premiums or cash value. There are also riders to cover other family members, spouse, children, on the primary insurer's policy.
These riders really show how you can fine-tune a policy. Lastly, let's touch on life insurance policy exclusions. When might a claim be denied?
Exclusions are specific circumstances listed in the policy that, if they cause the death, mean the insurer won't pay the benefit. Fewer outright exclusions now, sometimes replaced by higher premiums, rate-ups for certain risks.
What are some common ones still seen?
War is a classic to avoid catastrophic losses. Can be status, no coverage if in military, or results, no coverage if death is a result of military action. Aviation often excludes high-risk flying, like private piloting or stunt flying, but usually covers commercial flights. Commission of a felony if death occurs while the insured is committing a felony. Illegal occupation. Sometimes intoxicants and narcotics, if contributing to death. We already covered suicide in the first 2 years. Hazardous occupations or hobbies might be excluded or rated up. And sometimes a change of occupation provision allows benefit adjustment if you switch to a riskier job.
Wow, we've covered a huge amount of ground from the basic structure to cash values, payouts, dividends, riders, and exclusions. It really highlights how these provisions and options shape the entire contract.
Absolutely, and hopefully breaking it down like this helps you, the listener, understand these moving parts better. Knowing what these clauses mean is so important for making good decisions about the coverage you need.
This deep dive has definitely laid a strong foundation. But as always, the specifics of your policy or one you're considering are what matter most. Dig into those details.
Which leads to a final thought. We often talk about the fine print, but think about how these details, these provisions and options we discussed, aren't just fine print. They are the very mechanics that determine the security and peace of mind your life insurance provides. So what specific aspect of your own policy or one you might get in the future truly warrants a closer look based on what we've talked about today?